Remember this, every year, approximately 8 million children are reported missing worldwide. Approximately 840,000 children are reported missing each year in the United States. 2,300 children are reported missing every day in the United States. And every 40 seconds, a child goes missing or is abducted in the United States. So the FBI estimates that between 85 and 90% of these are children, of course, and a large percentage are put into the sex trafficking chain, are used for people's pleasure, and murdered and never found. Recently, the feds reported 85,000 children were missing in the interior of the United States, ladies and gentlemen. You think that just happened? Ladies and gentlemen, that happened by design. That just doesn't happen. I wonder why. So we need to protect our children. Keep an eye on your children if you have children. And also remember this, puppets fall when their strings break. Joe Biden, cognitive decline, is at such an accelerated rate, the man has no business in the White House. It's an embarrassment, and the world is laughing. So, spring selling season was not sexy, but what comes next may be worse. That's what mortgage applications and investors calls are telling me right now. The 7% mortgage rates are back. The average interest rate on a 30-year fixed rate mortgage with conforming balances jumped to 6.91%, the highest since November. That's according to the weekly measure by the Mortgage Bankers Association. So, the feds have been meeting. Remember, inflation's transitory. It's not working out. They're throwing shit at the wall. They don't know what they're doing. Check out this chart. So, inflation is still running too high, and recent economic data is beginning to convince investors that the Federal Reserve will not be cutting rates anytime soon. And that's how all the data that I'm looking at, Mortgage Bankers Association explained last week. And it's pretty obvious. They don't know what the hell they're doing. Elon Musk warns, of a massive meltdown in the U.S. real estate sector, specifically commercial real estate. I've been following this for a year, and I've seen the writing on the wall in my videos over 8 months ago. Commercial real estate is melting down fast. Could it be home values next? Not so fast. Like I said, I've been talking about the commercial sector for a while. The U.S. commercial, real estate sector is under intense pressure, which is soon likely to spread to the residential property markets a little bit. That's what the billionaire Tesla, SpaceX, Twitter, big man on campus, Elon Musk said. I agree with the broad stroke picture. The first being commercial real estate. You have to break it down. So, commercial real estate has been struggling due to the bank failures, the tightening lending, the regulations, and the rising interest rates, number one. It shows how fragile these people are. The trend of, working from home, which gained momentum during the COVID-19 lockdowns, has made the situation even more difficult. And that's from my opinion. I've done videos of that, industry experts. JPMorgan recently estimated that it could default on about $450 billion of commercial real estate loans maturing this year, and a lot of these are maturing this year and they're coming due. While Morgan Stanley predicted that commercial real estate prices may plunge by about 40% in the next year. Following all this stuff, people are defaulting left and right on major loans, $750 billion. And I've done talks on this. A letter that I read found that a record $2.5 trillion in U.S. commercial real estate debt was due to expire over the next 5 years. $2.5 trillion. This is the real estate problem. Many cities have high office vacancy rates. Mortgage portfolios are at risk too if housing prices drop significantly. I agree with that. Musk talked about that. According to Morgan Stanley, small and medium-sized U.S. banks hold 80% of the U.S. commercial real estate debt outstanding. That's not a good sign. And some, however, argue that the situation in the U.S. residential real estate market is not as dire as Musk says. I would agree with that. A lot of people paid cash this time. So in response to his tweet on Monday, CEO of Redfin, they've had some issues, Seattle-based operator residential real estate brokers, tweeted, the loss in demand for commercial real estate is what's driving demand for residential real estate. You got to look at it regionally. Defaults are up nationally. Foreclosures. So you got to kind of break this stuff down. People who work from home, he feels need more space from home. Sales volume is down because inventory is down. That is true. And, and today home prices increased for a second straight month in certain sectors, Redfin is saying. So according to the seasonally adjusted Case-Shiller National Home Price Index, U.S. home prices have fallen 2.2% from June 2022. However, the situation differs from state to state, and that's the key, with cities across, the Midwest and the East Coast recording prices near at all-time highs. You look at LA and it's priced right. Yes, prices went up 44%. They're selling, getting multi-offers. So why is this happening specifically in commercial? The rapid money creation, ladies and gentlemen, I've talked about this, a lot of people talked about this, in 0% interest rates during the COVID pandemic, on top of the 3 rounds of quantitative easing, just print, and more than a decade of artificially low interest rates in the wake of the 2008 financial crisis created all kinds of distortions and malinvestments in the economy and the financial system. Interest rates in a healthy economy should never have gone below 10%. Never. It was inevitable that something would break when the Federal Reserve, tried to raise interest rates in order to fight the price inflation it caused with all this loose monetary policy. Made people very vulnerable. Those thin, tight margins. And, easy money is the lifeblood of the U.S. economy and financial system. The Fed started draining the lifeblood away when it stepped in to fight the price inflation. It could no longer write off as transitory. And they rode that transitory wave. I've talked about this for a year. I saw the BS on the wall. There was no way the central bank wasn't going to break something. And the first crack in the dam was the outgoing financial crisis kicked off by the failures of Silicon Valley Bank, SVB at San Francisco, and Signature Bank. Just a joke. The Federal Reserve and the U.S. government managed to plug that hole in the dam with a bank bailout, folks. But there are plenty of other cracks in the dam if you follow this, and it's very frightening. It's not unlike the housing bubble. The Fed blew up in 2005 and 2006, in my opinion, but this time it's concentrated in the commercial real estate, such as office building, which is huge, multifamily housing complexes have been defaulting, in apartment buildings. These guys had some big loans. So as the Washington Journal described it, many investors were highly vulnerable to interest rate increases over the past year that crushed the business model they and thousands of other similar deals across the U.S., had hoped would make them wealthy. And that's according to the Wall Street Journal. Those are the trends that I've seen, and looking at the defaults of these major office and some of these multifamily complexes. It's a serious situation. It's a looming investment property disaster. And when all this stuff comes due over the next 5 years, and a lot's coming due this year, so investment companies had taken out, commercial real estate loans that carried floating, this is key, floating interest rates that were adjusted each month. So those types of loans in 2021 offered great initial rates at like 3.5%. So everything changed when the Federal Reserve began raising interest rates last year, driving up monthly loan payments. Inflation contributed to higher expenses, and, you can't raise rents, for example, fast enough to keep up with the inflation pace. And after bills have been going unpaid, company properties went into foreclosures. Many syndicators are racing to either raise funds right now. I'm on some of these calls, we're getting calls, or sell properties before tipping into foreclosure. Most hold balloon payment loans that require repayment when they come due this year or next. So those syndicators face large payouts at a time when, getting new, more affordable property loans will be difficult right now. People are looking for cash. So, even firms with multi-billion-dollar portfolios have used syndication to buy apartment buildings that no longer make enough money to, cover, the debt payments, and that's what, the bond documents show. So right now, many investors are pulling out of the housing market. You're an astute investor. There's going to be some good buys. I follow the withdrawals of listings, the price drops, foreclosures. So purchases by investors plunged by 49% year over year in Q1 in the metro areas. Widespread economic uncertainty, the recession fears are also prompting investors to pump the brakes a little bit. We're in a recession. Some investors may be moving their money into other assets, classes we're seeing on the financial side, my brother, that offer better returns, stocks, bonds, if you know what you're doing, and get those dividends. So, the biggest year-over-year drops of purchases by investors, if you look at this chart, take a look. Nassau County, New York, 67.9%. Atlanta, Georgia, minus 66%. Charlotte, North Carolina, minus 66%. Phoenix, Arizona, 64.2%. Nashville, Tennessee, 60.4%. Las Vegas, 60.2%. Jacksonville, 56.6%. Philadelphia, 56.5%. Tampa and Orlando coming in at minus 54.7%. So, with that 7%, mortgages now hammering the end of the spring selling season and investors pulling out of a large scale home sale, home sales, going into the summer could turn out to be dismal right now. So the bottom line is pretty simple. The Fed created this problem long before, when it held rates artificially, low for so long. It incentivized all this borrowing and risk taking and these floating loans on these multifamily office buildings. Everybody just assumed rates would stay low forever. So they, leveraged up and took out more and more risk. And that's what you're seeing right now. I just wanted to give a top line on that, but it's mainly concentrated in the commercial sector. This time around, compared to 2008, like I said, a lot of people pay cash. They don't have mortgages. You have to break it down regionally. Defaults are up, and in a lot of sectors, it's concerning. Stuff is sitting on market a lot longer, all the stuff I'm looking at nationally. But you're an investor. There's some good buys coming up if you were smart and held on to your cash. But a lot of these syndicates, I got a call for a fourplex to get involved in a fourplex, and we're looking for more doors than that, to help out with the rehab cost. They need cash out of Arizona. It's just too small of a deal. They need investors to help with the rehab and said, hey, you go on the deal, we'll give you a percent of the deal. I'm seeing more calls like that. I'm hearing more calls like that in my investor groups. So what is the effect these large multifamily complexes that have defaulted? How's that going to lever down to the residential sector? We'll have to see. Musk, of course, he's sounding the horn on that, but I agree with him on the commercial side. That's the 800-pound gorilla. We'll have to see how it trickles in the residential. Inventory is still low nationally, and you're seeing homes priced right in the market sell. Everyone's still artificially inflating their prices. Like I said, things went up 44%. They go down 20%. Not a big deal. Not a big deal. So there is some serious cracks in the commercial sector, and a lot of these loans are coming due. So put your creative hat on right now, but there is going to be some good buys out there. Take care. Have a great week.